All right, and we are back. And thanks again to everybody who is participating and here. So again, my name is Patrick Driscoll. So this session works in the following way. At the bottom of your screen, you will see a Q&A button and a chat function. We're going to use the Q&A function. So if you have questions throughout, please feel free to use the Q&A. The chat function we will not be monitoring, but you can use that to introduce yourself or communicate amongst yourselves as well. And at the end of the fireside chat, we're going to actually use the Q&A to ask Amanda and Amit some questions. And with that, I'd like to introduce Amit Bhatti. He's our corporate counsel at 500 Startups, and Amanda Parsons, who's the equity admin business lead at Carta. And I'm going to allow them to introduce themselves a little bit more. And with that, welcome to everyone, and I'm going to pass it off.
Hey, everybody. Thanks for joining us this afternoon. I think my background is really much less interesting for what we're talking about here. So really, we should start off by welcoming Amanda.
Thank you.
And Amanda, why don't you tell us a little bit about yourself, your background, and what Carta does?
Sure. My name's Amanda Parsons. I run our equity admin business at Carta. Carta is a cap table management and stock plan management and investor management and fund management platform. We're taking over the world, I think. We have approximately 10,000 clients right now, over that on our platform, and we're growing every day. What I do is I actually get into the weeds with usually our bigger clients, larger enterprise private companies, and help them figure out their stock plans and help them with their day-to-day problems. I also get in the weeds of like spin transactions and repricings and things like that. So I'm betting there's some overlap in things that we advise clients on.
Right.
And I have worked for it both in-house and for other vendors before. So I've worked at Twitter, the Hershey Company, and a couple other places in-house in stock plan administration and equity compensation. And on the private company side, I worked for NASDAQ Private Market and sort of did the same thing that I'm doing now at Carta with our larger enterprise clients.
Great. Yeah, I can say from my perspective, so I both used to work as an attorney at Wilson Sonsini, and then now here at 500 Startups, I deal with lots of early stage all the way up to later stage startups. And when people are using Carta, it's always such, or any kind of really like sophisticated cap table management software, it's always such a big plus for us as investors to see just exactly clearly what the cap table ownership is, because we see so many bad practices. So before getting into bad practices and tips of that sort, I think what would be really helpful for those on the line that are not as familiar is just what exactly is a cap table and what does it show beyond how many shares I hold?
Sure. A cap table, for those of you who are not super familiar, is simply pretty much a high-level overview of who owns what of the company. So as an investor, you probably see these. If you're a founder, you hopefully definitely have a cap table, although we've seen a few that don't.
Definitely seen when they don't.
Yes. But it should show exactly who owns what shares. It should show your common, any preferred, any seed rounds, anything like that. That should all show up on basically a one-pager. Hopefully a one-pager on your cap table. And there may be more details that you need to add as you grow, but essentially it should just be one clear picture of who owns what.
Mm-hmm.
A very good cap table, or what we like to call a great cap table, shows anything like fully diluted. It will show exactly what happens if there's an exit. It will show the exact percentage that each person owns. So it can get a little bit into the weeds, but still on a big picture view, if you have major shareholders that own maybe 5% or more of the company, everything should show on the cap table.
So if I'm an investor,
Yes.
and we see this question all the time, and I invested several years ago and I bought shares at that time, and I'm wondering like, what's the status of the company now? And what type of things do you think as an investor you have the right to see as on the cap table of a company? Like, and how would you go about making that type of request?
It's definitely, I would say, negotiable. I mean, it depends on how big of an investor you are. It's, if you're a board member, so if you're an investor that also has a seat on the board, you should have full access to the cap table, hands down. I mean, you should see basically anything the founder should see, because you have to keep tabs on what's going on in the company. If you're a major investor, however you define that, probably 5% or more, but could be flexible, you probably should have a pretty big picture view of the cap table and who the other major investors are.
And you would normally go to the company to get this information, or?
Yes, generally. I mean, if they use a platform like Carta or someone else, they can hopefully ask for access, but that has to go through the founder and whoever has control at the company. It might go through the law firm as well.
Sure.
And the other, if you're a minor investor, you might not really need an in-depth view of who owns what, but you should still have at least a high-level overview of how many shares are outstanding in each class, so you can do your own, waterfall analyses and any other analysis.
Yep. Yeah. So just to add to that, I think one of the tips I always give people is if you're an investor, even if you're a minor investor and you only have a small stake, it's always a good idea, rather than wondering and trying to piece things together. It's always best to just ask for, how many shares do I hold and what's the summary cap table? So I think you definitely correctly, pointed out that only major investors or people sitting on the board are probably going to see the whole thing. But even if you own one share, you as a stockholder in Delaware have the right to ask for what your stake is. And, the summary cap table is something most people should expect to see, so you know what percentage ownership you have. So cap tables are constantly changing. And I think one question people have is, when does the cap table get updated? Like if there's an event or if somebody's issuing options and things like that, things are always moving. So if I've bought my shares at one point and I knew I had 100,000 shares, how often do things change? And when do you see those types of things getting reflected on the official cap table record?
Depending on the size of the company, it could change daily. So, you should be, as a founder, you should be recording everything that happens. So financing rounds, any transfers, any secondary transactions, any new employee grants, all of those things should be recorded as they're happening. And I know that's easier said than done, but it's definitely easier to record them as they happen than to pay a law firm $25,000 to go back and enter everything later.
Probably more than $25,000.
That's true. That's true. We've even heard up to $750 an hour just for a paralegal, much less not even a partner at a law firm, to be looking in your cap table. So it's much easier to keep on top of things as they happen. And if you need help, hopefully you have a vendor that has support and you're using some kind of software other than Excel. And we'll talk a little bit more about that later. But generally, keep the cap table up to date.
Yeah. So that being said, what are some of the benefits to both companies, investors, everybody involved, really, to having a clean cap table? Like, why should I care, basically?
There are so many reasons. We see at Carta all the things not to do, I would say. So no offense out there if you're a Carta client, but we see lots of errors and things. We might get a new company, say with 200 or 300 stakeholders, so a fairly large enterprise company who hasn't updated their cap table in a year. Mm-hmm. And then, how do you reconcile that for when they're onboarding to Carta, when you're looking at Excel? If you haven't updated anything for the past year, where do you even start with that? You have to go back, you have to retrace your steps, you have to go to your attorney, figure out everything that happened. You have to see, okay, what new grants did I issue and where are they recorded if they're not recorded on the cap table?
You're spending with companies, if I'm an investor, I'm saying I need the record of this before I make a new investment.
Right. Yes, it could, and it could be a months long process to go through and reconcile everything if you get really down the road and haven't updated anything. And we do see that often. So that's not a one-off situation for sure. I mean, people just don't view this as generally important unless they have an investor or somebody on their board who is really pushing them to record everything as it happens.
Yeah, I think that's right. Both in law firm life and at 500, I've seen this happen over and over again, where even if we make a pre-seed type investment in a company, and we think the cap table looks good when we made that investment, then when they go out to raise their Series A, in the meantime, people have kind of neglected that piece of things, and so then they've calculated they have this much runway, and they've done all the meetings, they've done everything right, and they've found some investors and they want to invest, and then all of a sudden they get the cap table and they start doing diligence, and it really holds up the process. So I always try to impress on founders and investors is, if you're an early investor in a company, you should be advising your companies that this is really important for them to reach that next fundraising target, because if they don't and things get delayed and a term sheet falls apart because the diligence wasn't clean, then they're not going to have any leverage to raise that good round. And you as an early stage investor are then maybe stuck with a worse term sheet for the company. So I do think cap table health is one of those really easy things that people should do, but it's not fun, it's not interesting.
Right.
And so people tend to neglect it.
Yes, absolutely.
Yeah, so definitely wholeheartedly agree there.
And also a red flag, just to build on that, for an investor, if you're looking at cap tables when you're doing due diligence and you see that it's from October 2017 or something like that, that's a huge red flag. I mean, that means somebody is not paying attention to what's happening in this company. Yeah. So that's definitely ask for a current cap table. And if they sent you an old one, that means they probably don't have one, right?
Mm-hmm. So building on the errors, I think, because that's really where people, I think, find, I might be doing these same things. What are some of the common errors you see people making, or could we walk through a couple different things where you've seen this happen and how it gets mitigated and how those errors affect both the company and the investors?
We could talk about this all day, I think. Let me just pick a few from the latest client cases that I've seen. So one huge error is not having a 409A valuation on file when issuing new option grants, which can lead to some major repercussions.
So can we talk a little bit about what a 409A is?
Sure. 409A valuation is simply basically an auditable valuation of your company. That's how I would say it. So it's just a stock price that you are allowed to issue option grants at. And we see private companies ignore this fact pretty often, and some go years without getting a 409A valuation and issue tons of grants. And we actually had a very large enterprise company recently come to us that they have clearly violated 409A, meaning they have been accused of issuing cheap stock. They have been paying penalties on this. And instead of restructuring how they did everything and reissuing new grants, they made their grants basically compliant with 409A, which is not necessarily what I would have advised, where it goes really in the weeds, and you have to put exercise triggers on every option so that every time, basically after somebody has a year vested, they have 90 days to exercise, and if they don't, they lose that part of the grant. Oh, wow. I mean, their grants are now extraordinarily complicated. So don't do that. Essentially, it's easy to get a 409A. You can get a cheap 409A at many different places, including Carta. It's not something that you want to skimp on. I mean, this company's probably spending hundreds of thousands in legal fees to mitigate what they've done here.
Before we jump on into another error, just building on that, I think 409A is one of those things that it's important to the company, it's important to the employees, it's important to the investors, and for a variety of reasons. So just to explain a little bit more of the background of 409A, it's basically a safe harbor from the IRS that if a company has a 409A valuation, that's the value of the common stock at the time. And so if you're issuing common stock to employees, you can point directly to your 409A and say, I've issued this at the current price. When companies don't do that, like the example we're talking about, you're creating huge liability for the employees when you're issuing stock at an incorrect price. And then those employees, your early stage employees, are going to have a huge amount of unreported income, basically. And then, so your employees are going to be unhappy. The company's going to be unhappy that they have to fix this. And investors, at least really savvy investors, when they're doing due diligence, especially for later stage rounds, check through every one of these things. And when the 409As are not done properly, they generally carve out that liability when they're investing in the company, and they say any liability here or any amounts that you're going to have to true up your employees for tax payments and things like that, we're not going to be paying for that, or all money we're investing is to grow your company. It's not to pay for your earlier errors. So as investors, employees, company, like that's a hugely important issue. And it's one that, for your employees especially, I think it's the biggest thing, because if your employee is working somewhere, has worked hard, is taking equity and a lower salary to really build on your idea, and then they're hit with some huge tax bill, they're probably not going to want to work there much longer.
Right.
So what's another typical error that people come up with?
This may sound stupid, but names are the biggest thing that we see.
Okay.
So think about it. If you have two investors, Google Ventures 1 and Google Ventures 4, they're two different things, right? I mean, you want them listed on the cap table as two different entities. You might want to group them together in a group, which is fine. We see all the time where there's typos in the names, and Carta is a transfer agent. So we're actually tracking and issuing the electronic stock certificates. Mm-hmm. If you have the wrong name on there, that's a big deal. That turns into a legal issue. Yep. So just very simple, keep the names up to date. If somebody owns more than one thing, make sure that the name is spelled correctly on each item, because we're a transfer agent. Those things need to be correct. Maybe if you're just using Excel, it's not as important right now, but to be fair, if you're planning on growing your company, you want those things to be clean now, so that when you eventually do move to a cap table software or something like that, that you have everything correct for onboarding, and you're not just compiling more errors on top of errors. Yeah. So names, every single company I've ever seen has naming issues in their onboarding materials when they come to us. Definitely.
I think in my experience, what I've seen is that sometimes these errors don't even get caught until a company is preparing for IPO. Right. And then there's an army of lawyers combing through every single line item and then catching these errors. And then again, like we mentioned before, there's costs in fixing all of this stuff. So
we also see that pre-audit. So not just IPO, but when they're big enough that they warrant an audit, even if they're not thinking about IPO right now, they come to us freaking out. Like, all right, Jessica K. Smith and Jess Smith are on here. Is this the same person? I'm like, wait, you tell me. like you have to tell me if that's the same person, and then I can fix it. But that's the most common and the most easily avoidable thing that you can do, is just have your shareholder names correct and consistent across the board. Mm-hmm. But the other thing is good contact information for people, because that gets more and more important as the company grows. I mean, you need your investors' email addresses somewhere, right?
To send yearly notices.
Yes. Like that. Could be anything. I mean, you might need to do 701 disclosures at some point as you grow. I mean, those things, you need some kind of electronic communication method with these mm-hmm. folks. So that's another big one. I mean, I could keep going on this forever. So you tell me if you want me to.
No. I mean, I think we've outlined some of those things. I think another area where people tend to have questions is what happens with things on the cap table where employees have left and they maybe haven't fully vested, or maybe they have fully vested and they haven't purchased their shares. Is that the type of thing that you see sometimes not properly reflected by companies?
Constantly, both public and private companies. So it's across the board where there's Basically, people leave the company, whether it's voluntary, involuntary, or for cause. It doesn't get recorded in the cap table on a consistent basis.
As an investor, that's a huge issue for you because, there's equity and dilution going out the door that you never needed to do, but just because of the fact that cap tables aren't being managed properly, you're basically losing ownership in the company. And I think, again, that's part of the whole issue of this webinar is to say, this is something that even as an investor, this really might seem like a company issue, but it affects your bottom line. For the company, if you're the founder and you're giving away equity in that sense, it affects your bottom line, other employees, everybody. Like it's really one of the most important things for a company, but it's one of the most overlooked.
Yes. And the reason is, when somebody terminates, if they're not fully vested, let's say they're half vested. So there's, 100 shares that they're vested in now, and there's 100 shares that aren't vested when they leave. That 100 shares gets added back to the option pool. And that's important to your bottom line. So you don't care if somebody's left or not, generally, as long as it's not the founder. But you do need to know that those options are being correctly added back to the pool when applicable. Or if they extend a post-termination exercise period, which we're seeing all the time now, that also affects you, because that means that those options are outstanding for a lot longer. Some are extending them 10 years. It's insane. So all of that affects the pool. That means nothing's being added back to the pool when it normally would be added back after the 90 days after termination.
Yeah, I think that's especially because people are trying to introduce terms like this that are more friendly to the employees, which I think is great. I think that's what makes things like Carta and other types of management software so important, because the thing I loved when I'm logged on to Carta and when I'm working on this, even from the law firm perspective, is that it automatically stops you from doing things that aren't that don't add up. Like the system can tell, like, this doesn't make any sense.
Yes.
So from the investor perspective, I think it's always really important to, when you're advising a company, even saying like, hey, once you're reaching a certain level of complexity, make sure you have some kind of system, and Excel is not going to cut it anymore.
And even for small clients, I see Excel not really working anymore. We had a tiny client who maybe 25 stakeholders. So you think, sure, Excel might work. But they were an LLC, and they issued UARs, which I don't even remember, unit appreciation rights, I believe.
Okay.
And then they transitioned to a C Corp and started a new option plan and everything. And I got involved because they were like, wait, how do we do this on Carta? And Carta's pretty straightforward. It's meant to be a self-service platform. But when you have something that's that complicated, generally you need somebody to jump in and help. And this particular client, even though there are only 25 stakeholders, you would think this would be easy. We basically had to re-onboard them because they're a completely new company, completely new option plan. You just need to have a system. If there's any level of complexity, Excel doesn't cut it. Excel doesn't detail vesting schedules and break down post-term exercise periods. And, when it comes to the stock plan, Excel for sure doesn't cut it. So if you have any kind of option pool and there's more than a couple option holders, you need any kind of system. And you're selling Carta more than me. I'm not here to sell Carta for sure.
Not Carta in particular, but
anyone.
I know for me, when I was working specifically for companies on the law firm side, when they had some sort of management software, they usually caught a lot of errors.
Yes.
Without that, even when it was being managed by the law firm, we use software to prevent these types of errors from happening, but it's when companies are just doing it on their own that a lot of these things happen. And it has to do with whether the company is reporting all these things or not. So if you're a board member and you're an investor, that's a question you should ask. Like when you're passing a board resolution with options in it, it's a simple question to say like, hey, where are we managing this? And when is this going to get updated? So last question I'll ask before we jump into questions, because I see that we have a couple questions built up here.
Okay.
And you've already kind of maybe answered it, but when would you recommend a company, at what stage should they really start using some type of software to manage their cap table? Would you say like as soon as an option pool is started, or when they raise their first financing round? Like, when is it that they really need to focus on doing this in a professional way?
I would do it immediately. So, I mean, if I started a company today, I would stick them on Carta or any platform, really. Probably me, Carta, but just make sure that you're set up for success immediately. The larger you get on Excel, the harder it's going to be to switch to a software platform. So it can turn into like a 6-month onboarding process if you have a hugely complicated Excel file that doesn't track everything that we need. And if you've been issuing option grants on paper, I mean, that's something we didn't really hit on, that, I'm a big fan of nixing paper in whatever way possible. And I've worked with public companies that actually do everything on paper, and it drives me insane. I actually worked somewhere where I had an entire basement full of files. And this was only a couple years ago. I'm not, ancient. I'm a little older, but, when you start doing paper stock certificates and paper option agreements and you have to keep copies of everything, it gets insane very quickly. And those things generally have to be retained forever. Yeah. So for retention purposes and everything else, you want those things electronically. Another argument for electronic is we've actually seen an example where I think it was Hurricane Sandy, like 2012-ish. One of the DTC centers got wiped out, and like 1.2 million stock certificates. Not $1.2 million, 1.2 million individual stock certificates actually got wiped out in the hurricane. So if you're relying on paper certificates and paper storage, paper option agreements, you're always running the risk that that stuff is going to be lost forever. And you can't necessarily rely on the law firm to pick up all the pieces, although we do see that quite a bit, where the law firm has to come in and save the day.
It's always great when lawyers get credit for something, but
yes.
So with that, I think we want to jump into everybody's questions, so we can really focus more on the topics that are concerning to everybody on the line. So Patrick, I think, will help us throw out some of the most the most asked, in consolidating some of the questions. So if it's not exactly the question you might have asked, I think he's putting together the questions so we get to the topics that are most concerning.
Fantastic. Thank you so much, Amit and Amanda. We do have quite a few questions so far. Just a reminder, please put your questions in the Q&A. I'm not going to look at the chat function. So if you have put them in the chat function, copy and paste them over to Q&A. Thank you all very much. All right, and the one takeaway that I have so far is make sure that you spell everyone's name correctly. So everyone should write that down, please. And the first question, the first question that I have is from Chloe Fagan Tucker. She asks, what are your views on having numerous angels and random investors on a cap table that you're reviewing for diligence? So to put them on beforehand.
Okay. I'll take this one. Yeah. So I think if there's a lot of different angels and other investors on a cap table, it wouldn't be as concerning to me as the percentage ownership they really have. So in that case, you really want to have the detailed cap table so you can tell how many shares do these people own and what percentage is it. And depending on what stage of investor you are, you want to take into account, do these people hold a large chunk? Does the founder still have enough equity where the founder is motivated? If it's a really early stage company, is a Series A investor that's going to come in and usually want to buy around 20% of the company. When they buy that chunk, is there going to be enough ownership left? So I would say sheer number, probably not that important. There's very few things that you need every single stockholder to sign on to, though there can be a few things like, sale of the company. There you might need really high thresholds, but generally it's about percentage that those people are owning that I would care about.
Awesome. And then in terms of software, I know we can't necessarily plug any specific software, but could you give kind of an array of options for folks that are interested in switching software?
I can. I actually, there's tons of competitors out there. So, Carta does this. There's lots of other companies. I'm probably not going to give you all their names, but I think my marketing and sales folks would murder me if I did that. But essentially, you're looking
Google
for,
search will tell you.
I mean, Google cap table management, stock plan management. I mean, for public companies, the options are like E-Trade, Fidelity, things like that. For private companies, it's a little bit different. And it's usually companies you haven't heard of unless you've been in this space for a while. I think Carta is probably the largest private company cap table software. And I'm partial since I work there. I can't plug them, but you should definitely do your diligence. Make sure it's not just recreating Excel. I've seen a lot of people paying for software that is essentially Excel in web form, which is not what you're looking for. That's not going to do everything you need to do. And if you're a company that is planning on some significant growth, make sure that they can handle the things that you might do in a year or two. Don't look at just today. If you're going to
onboarding and switching is going to be even more of an hassle.
Yeah, switching vendors is a pain. So make sure you pick somebody that can grow with you. If you're considering issuing RSUs, for example, something like that in the future, you want to make sure the platform supports RSUs, which Carta does, by the way. If you're just make sure that they do everything you need them to do. And if you're not sure, just ask. I'll give you like a checklist that you can take to different platforms. And it's not going to be based on, I'm not in sales, so it's not going to be based on what looks better for Carta, but it's what I would look for if I were in your shoes. But definitely not Excel. I mean, if you're over 5 stakeholders, I would not use just Excel.
Yeah. Great.
Awesome. And now this comes from Asha Martin, and it's focusing on international companies, and they're Australian. They're looking to incorporate in the UK and USA. And they want to know what are the pros and cons to having separate cap tables per country as opposed to just being incorporated in one country.
So you might have a different opinion on this, but I would say depending on the company structure, it's pretty unusual for there to be separate cap tables, because at least for VC-backed companies, what VCs are generally going to look for is that they're going to want to invest in, like, say, the top level entity. So like the holding company that sits above it all. That might be the Australian entity, it might be the US entity, it might be the UK entity, whichever one you're choosing to set it up as. And then all the other entities below it, the subsidiaries, should generally be 100% owned by the entity at the top. So really the cap table, in the sense of ownership that we're talking about, like if it was just a standard Delaware C Corp or standard US company, you should just have one that the employees are getting interests in. I've seen some limited scenarios where companies that are, say, based in Australia and have like a Philippines development arm, and then US entities and things like that do it a little bit differently, but generally you want the cap table where all the employees, investors, and anybody having an ownership stake in the company, you want that all to be in one place rather than several distributed areas, because then it's really hard to tell, well, who owns what percentage of this company as a whole. And all of those subsidiaries should generally just be owned by the top entity.
Yes, and we do definitely see exceptions to this. I mean, we're seeing lots of very complicated legal structures lately, but for your investors and employees' sake, I think it's better to keep it simple. I mean, that's something I didn't really touch on here, but I am a big proponent of not doing anything that you can't explain within a minute to your investors or to your shareholders or your employees. Because if it's something that complicated, let's say you're issuing a very complicated employee grant with lots of different triggers and things like that. Employees barely understand stock options for the most part, even just basic ISOs. Once you start adding more complicated things, it goes out the window where it's not helping you retain or attract employees anymore.
I always advise people not to do milestones on stock option grants, because for this exact reason.
Yeah.
So you can't define them properly. your priorities as a company might change.
Right. So the same thing applies to structure. If you can't explain it to somebody in a really quick manner, you're going to have a hard time attracting the investors that you want to attract and attracting the employees that you want to attract. So keep it as simple as possible would be my 2 cents.
Great. All right. And the next question comes from Sajid Johnson. And what are your thoughts if a company is an LLC and the main investor only wants to do profit sharing model versus equity type standard model? What are the pros and cons of this?
All right. Well, I'll take this one.
Yes, please.
I would say most VCs, if we're talking about a VC-backed company, will not invest in an LLC. So profit sharing model makes sense for an LLC because it's a pass-through for tax purposes. So they're basically trying to pass those profits directly to whoever's invested in it, and then everybody has to pay tax on whatever taxes would be applicable on their own returns. That's just not advantageous for any kind of fund to invest in, because none of the investors that are in the funds want to have any kind of tax liability, and especially not connected to whatever country it might be that you've invested in. So I would say extremely uncommon to have LLCs where you see a lot of institutional investors. If you're making an angel investment in like a certain type of business or into real estate or a smaller lifestyle business, I think that can make sense. But I think for the purposes of like a company expected to grow into an enterprise that's backed by VC, I would not keep an LLC structure.
Yeah, I'm a pro C Corp structure myself. I mean, we do have lots of clients that are LLCs and LLPs, and now we have a triple LP. So there are lots of different things, but it goes to the same thing I was saying about keeping it simple. Try explaining profit interest units to employees. You know, it's almost impossible. If they don't understand the basics of a stock option, are they really going to understand the inner mechanics of a profit interest unit? And I could tell you that the employees come to me all the time and ask me to explain what the heck is this? What's this award? So more so than they do for regular stock options. So, keep it simple as humanly possible. It's my only opinion there.
Yeah. Agreed.
Simplicity is best. And this is from Shiva Venkantraman. One of the companies that Shiva invests in is shutting down, and they got an email from their founder to this effect. What mandatory disclosures on the cap table does a company need to give to their shareholders, minority or from a legal perspective?
I don't know if you want to start here, but
I actually don't. I can't think of anything.
Okay, yeah. So I would say, sadly, not a whole lot of like mandatory disclosures when you're dissolving in this case. All that's going to be driven by like the law in the state that or country that the company is incorporated in. There's not going to be anything like cap table related happening at dissolution because there's no value there anymore. So at that dissolution, what you would expect is based on the terms of the company's certificate of incorporation, if it was a U.S. company, the funds will be distributed according to like the terms in there and according to the percentage interest everybody holds. But there's not some kind of mandatory disclosure in terms of, the company is shutting down or anything like that. That's based on like cap table management. That'll all be based on, Delaware statutory law in most cases.
Yeah, generally, just to add to that, I don't really see required disclosures, but in Carta we have a whole offboarding process for the company, and we cancel the certificates and things like that if they have no value. So you would actually, if you're an investor on Carta, you would actually get an email just from us saying, your certificate's been modified or canceled or something like that. But there's no legal language or anything that I can think of that is really necessary for them to send out.
Yeah.
Great. And we've got quite a few 409A questions. And this one specifically is from Carlos Liverani. And Carlos asks, at one point, should founders consider getting a CPA to make sense of all of the tax implications of a cap table management?
Good idea. No, I'm just kidding. You don't need a CPA. You just need people you can rely on. So find, either utilize your vendors like Carta or whatever other vendor you use for your cap table management, and lean on them for support. Yes, law firm. I know for us, Carta doesn't give advice, but I can walk you through anything. We do a lot of educational efforts. So even if you're not a Carta client, I can help you. Just reach out to us and we'll walk you through it. But 409A is it's an advanced concept, but all you need to know as a founder or investor is just make sure they have one.
And make sure it's current.
Make sure it's current at the time of grant, which current means within the last 12 months, generally.
Yeah, it's
generally.
Within the last 12 months, or if some significant event has happened.
Yes, if there's been a financing round, something like that, they need a new 409A. That's it. So you don't really need to know the ins and outs of it, other than you need to have one every 12 months, or if something big's happened, like a financing round.
Great. And in terms of 409As, so they're used for employee option plan strike prices. And so, for example, if a company grants some amount of restricted stocks to founders, advisors, or consultants, does the par value of the restricted stock have to be equal or above the 409A valuation at the time? It's from Xing Jin.
No. So the par value is pretty irrelevant. The par value is just kind of, I would say it's just kind of a holdover, and it's not really, not as significant in the US. I know that in European companies, sometimes there's more of an emphasis on like certain like capital paid in for stock based on the par value, but 409A and par value are not really related. It's really just important that you're issuing options at the par, not the par, that you're really issuing options at the 409A price to your employees. And without getting into 409A rules and such, you really want that to be as low of a price as possible for the employees' benefit. And it's not going to be the same price necessarily that the preferred stock is sold to investors. So 409A price, par value, and say a Series A price could be three different numbers.
Yes.
And that's totally fine.
Yeah, and I would, if it's restricted stock or restricted stock units, par value doesn't matter. The FMV does. So the FMV is generally the current 409A value. So it just matters as far as taxes. That's it. It doesn't matter as far as, really anything other than taxes that I can think of. Because you do owe taxes on restricted stock awards.
Great. And this is from Margot Flores. And she asks a legal question. Are things disclosed in cap tables, especially those in platforms like Carta, legally binding?
I guess it depends on what. I would say there's not a lot in the private company world that is legally binding. I don't know if I should say that out loud, but I
actually disagree.
There is.
Yeah, I mean, the certificates that you're getting through Carta are the legends and everything
That's true.
attached to them are legally
You're right.
binding. So
Yes.
if it's Carta, if it's something else, if a cap table is being managed online and you have your like electronic stock certificate, there's going to be a legend on the back that says something like, this is subject to, whatever rules from the SEC, and when it's being switched to a public sale, there'll be a lockup of however many days. All those things are legally binding, and those are coming from other agreements as well, but it's legally binding on a stock certificate.
You're right. And that may be specific to Carta, actually, because Carta is a transfer agent. Other places that might issue electronic certificates are not necessarily the legal transfer agent.
So it's just a fake little certificate.
Maybe. It depends on the platform.
Yeah.
So we've seen definitely not really relevant certificates out there. Not that everyone does that, but ours are legally binding. So you're definitely correct there. But stock option agreements are not necessarily legally binding. I mean, if it's not you're not like signing your life away or anything like that with that. There could be transfer restrictions listed in there.
Yeah, but the option agreement itself, in terms of saying how many shares you own or how many shares you have the right to buy, all of that stuff, if you're signing a legal document, that's legally binding. The spreadsheet itself, or the spreadsheet type view of these are the shares everybody owns and this is the percentage of the company it is, that's not really legally binding. That's just showing you the total. But all of that, at least on the good cap table management software, it's flowing from a legal document. And that's really the goal, is that you want a cap table to reflect exactly what's in the legal documentation. So I would say for a properly done cap table, I would say it's legally binding, not because it's reflected on this cap table, but because it's all coming from legal documents.
All right, we're going to get to 2 more questions. And the second to last is something that I find very interesting too, is from Anina Net. How does a cap table work with these new crowdfunding platforms, specifically crowd-funded angel investment?
Gonna leave this one for you.
It depends how it's set up. They may be set up as I'm probably going to use the wrong terminology here, so you can correct me, but they may be set up as almost similar to a syndicate, where it's just one line item on the cap table. That's the cleanest way to do it, so you don't have 2,000 people on your cap table when you're a tiny company. But if they all need to be in there separately, then that's going to be a more
pretty big undertaking.
Yeah, that's good. You're going to need a full-time cap table administrator in that case, if you start listing out everybody separately. But what I've seen the most of is just like a one line item for now. I'm sure that could change. I mean, this is all relatively new, so we're but what I've seen is just like angel investor syndicate or angel investor group or whatever you want to call it, right, as one line item, and then the percentage total owned instead of each person listed separately.
So I think a good example of this would be something like AngelList. So AngelList is like a really common platform that a lot of startups use. Even later stage companies use to raise money, to fill in a round, and investors use this all the time. So for example, 500 startups ourselves, when we have like some additional allocation in a round, we might post to a syndicate on AngelList. And what happens is all of these aggregated investors all end up investing in a specific entity called like a SPV, or a special purpose vehicle. And then that's the only thing reflected on the cap table. So in those cases, if you're an investor joining one of these things, you kind of have one step removed from the cap table, where you have to go through whoever is running that SPV to know what is my share of the total, and then what is our share of the entire company.
Awesome. And then the final question, and this will have all lawyers on the edge of their seat. So if a lawyer gets equity, how does a founder decide how much the lawyer gets?
If a lawyer gets equity, I think it's totally up to what the lawyer asks for and what the founder gives them. I don't think that there's any sort of rule of thumb or standard here. If you're a founder and you're choosing to trade equity for legal services, I've seen a range of different options. I would say generally stick to a reputable law firm if you're going to do this. Not like a solo single provider. Not saying that there aren't great solo practitioners out there, because there really are. But without knowing, and recommending specific people on this webinar, I would say if you're going to make this kind of arrangement, generally do it with a larger law firm that is really experienced in the startup and tech industry, because you don't want to end up in a scenario where you sign something wildly off market, because generally you're relying on your lawyer to tell you what market is. And so these larger firms that have built up a reputation over time, they have more standards as compared to what type of equity they're asking for. They might ask for a warrant rather than straight up equity, similar to like what a venture bank might do. So I would say there's no specific rule of thumb, but be careful and just be thoughtful about what you're doing.
Yeah, I can add to that. I mean, we see pretty frequently even larger startups where their lawyer is like their aunt's divorce attorney or something like that. Like they're not necessarily
Not a good idea.
They're not a business lawyer. They're not an expert in stock plans. They're just pulling off a stock plan from the internet, that kind of thing. That's why we see all the same stock plans all the time.
Yeah.
But when you're issuing somebody equity, just make sure it's somebody that you really want on your cap table forever and that you want to work with for a long time. So I would agree with what you said for sure.
Great.
All right. And we do have quite a few more questions. So what I'm going to do is actually send these out afterwards, and hopefully we could get these questions answered. But we have run out of time, unfortunately. Thanks so much to Amit and Amanda. Again, my name is Patrick Driscoll with the education team at 500 Startups. If you would like to see some of our prior recorded webinars, since this is kind of a process where we've been recording a lot of venture capital unlocked type content, you could go to education.500.co, and we also have links to our in-person VCU courses as well, such as Berkeley and Stanford and a few other options. If you have any questions going forward about our education programs or upcoming webinars, feel free to send an email to vcunlocks@500startups.com. Again, my name is Patrick. It's been fantastic. I'll pass it back over to Amit and Amanda to say their goodbyes, and thank you so much for everyone who attended.
Yeah, Amanda.
Sure. I just wanted to not plug Carta because I think Amit did that very well for me.
Sorry, it's been very helpful to me.
No, I'm grateful. I think it's awesome. But I just wanted to say we will get back to you on all the questions that you've asked. If we didn't answer them here, anything we see, I'll jump in and answer. And I see some people were asking for an example of a cap table, things like that. I can send you a couple slides that you can distribute to everybody if that's okay with you, just to show you what you should be seeing on a cap table. But generally, just high level percentage ownership, number of shares owned, dollar value owned, dollar value of the investment, I guess. But I really appreciate everyone's time. I think this is fun. So I hope that everyone got something out of it, and we're here to help. So please reach out with questions.
Yeah. Just thanks everybody for joining. I know cap table management and these kinds of things are not the most glamorous or exciting topics. So appreciate everybody jumping on the line, and always happy to share best practices, things we can do. So please reach out, please email us at VC Unlocked, and we'll hopefully put out great content for you all and help everybody get on the same page. I think the next program we're going to be doing in person is early in February, so February 11th to the 14th, and you can find more details online if you want to do more of an in-depth training on being an early stage angel or VC investor. But that's all for now. So thanks everybody, and we'll hopefully see you soon.
Thank you.